The idea of a few entities controlling the stock market is irresistible to conspiracy theorists. It evokes an image of shadowy figures pulling the strings of the global economy. But control over the stock market isn't so simple. If BlackRock, Vanguard, and State Street aren't the secret overlords of the financial world, then who or what really drives the market? The answer lies in understanding the forces at play: institutional investors, market dynamics, and the collective psychology of millions of individual participants. The power of institutional investors. It's true that institutional investors, like asset managers, hedge funds, and pension funds, dominate the stock market. These entities collectively manage trillions of dollars, giving them significant influence over market movements. For example, if a major pension fund decides to sell off a substantial stake in a company, it can drive the stock price down. Similarly, when an asset manager like Vanguard buys shares for its index funds, it can push prices up. But here's the catch. This influence is largely reactive, not proactive. Institutional investors don't buy and sell shares to manipulate prices. They're responding to market conditions, client demands, or changes in the indices they track. Their size gives them weight, but it doesn't equate to control in the sinister sense often imagined. Market makers and price discovery. If institutional investors aren't controlling the market, who sets prices? That job falls to market makers. These are the entities, banks, brokerages, and trading firms that facilitate buying and selling on stock exchanges. They quote, bid and ask prices, ensuring liquidity and smooth trading. Market makers don't decide what a stock is worth. Prices are determined through a process called price discovery, which reflects the collective actions of millions of participants. When you place a trade, you're contributing to this process. Every buy order, every sell order, and every piece of news is factored into a stock's price at any given moment. The role of retail investors. While institutional investors dominate the market in terms of volume, retail investors, everyday people like you and me, play a surprisingly large role in shaping trends. The rise of platforms like Robinhood and the meme stock phenomenon of 2021, I think GameStop and AMC, showed just how much impact retail traders can have when they act collectively. In fact, retail investors often set the tone for market sentiment. When confidence is high, they pour money into stocks, driving prices up. When fear takes hold, they pull back, contributing to declines. This emotional ebb and flow, what many call herd behavior, is a major force behind market volatility. The invisible hand. Despite all these players, institutions, market makers, retail investors, no one entity truly controls the market. Instead, the stock market operates as a complex ecosystem. It's guided by Adam Smith's invisible hand, where supply and demand interact to create equilibrium. But this doesn't mean the market is perfect or fair. It's subject to manipulation by those with insider knowledge, irrational exuberance, and even technical glitches. However, the idea of a single group or entity controlling everything oversimplifies the reality. Why it matters. Understanding who truly controls the market, or more accurately, who doesn't, is empowering. It helps demystify the forces at play and shifts the focus from conspiracy theories to actionable knowledge. Instead of worrying about BlackRock or Vanguard pulling the strings, investors can focus on what really matters: their strategies, risk management, and understanding the dynamics of supply and demand. The stock market isn't rigged in the way some claim. It's messy, unpredictable, and often irrational. But that's what makes it so fascinating, and for those willing to learn, so full of opportunity.